Good afternoon guys, welcome back to another video. In today's video we're going to be going over what chart types are and what candlestick patterns are. So stay tuned guys and let's get into it. As you know, this video is all about chart patterns and candlesticks, and hopefully you will learn a lot from this video so you can implement this information onto your trading and it'll help you become a better trader and predict the markets better than you usually do. So let's get started. First things first, please pause this video and read the disclaimer below. Please pause it for around 2 minutes. Once read, then please continue with the video. I'm hoping that you guys have read the disclaimer by now, so let's get started. First thing first, chart patterns. We're going to be going into what chart patterns are, what types of chart patterns are there, and how do we use this information to predict the markets better. So chart pattern guys, basically chart patterns are patterns that are printed in the market already. It shows you what's happened already in the previous, a day, 2 week, 4 hour, 1 hour, whatever your time frame you're looking at, whatever time frame you're using to do your analysis, whatever time frame you're using for your entry. And then you see these chart patterns, and then you use that information that's already been printed to enhance your probability to become a profitable trader, or to get into a profitable trade, or to predict where the market's headed next. So we use this information to see what's happened, and then we predict future information of what could possibly happen in future by using the information that's already been printed in the Forex market. So there's two types of chart patterns. First ones are called the continuation patterns. Continuation patterns are basically, as the word tells you, they continue. So we're looking for these patterns for the market to continue in the trend that it is currently in. More onto the next slide. And the second types of patterns are reversal patterns. So reversal patterns are, as you know, reverse, you're going backwards or you're going the opposite direction, however you want to anticipate that information. So as the word reverse means that we're looking for a reverse to go in the opposite direction rather than continuing, which means that we continue going forward, or we reverse backwards, or where the direction that we've come from. So more into that on the next slide. So continuation patterns, like I said to you earlier on, continuation patterns are basically, we're looking at this information, these patterns in the market for the market to continue. For instance, if the market, Euro USD, is in a bullish trend, now we're looking for a continuation pattern, i.e. we're still looking to buy, but we're looking for a pattern like a little pause or temporary, like a little break in the market where they're confusing traders that it could be a possible reversal, but it's not. So what the market's actually doing is just pausing for a moment and then continuing on its journey. It's like you're on a motorway, guys, and you stop at a service station for a break, but then you continue following your GPS to the direction you're going. So basically to get to your destination. For instance, in this case, Euro USD is bullish, it's paused for a moment to take a break, and then it's looking to continue its trend or go in the direction that it was going on after that little brief pause. So it's really important that we understand these patterns, because we don't want to be doing the opposite of what the market's going to do. We want to follow the trend, guys. Trend's your friend, as they always say. If the trend is your friend, then you follow it. We don't want to be calling that ends unless we have sufficient information, unless we have the patterns for reversals, unless we have something that tells us, right, the market is not going to continue. Whereas in this case scenario, we're looking to continue. So we're looking to go ahead with the trend after the pause that the market is doing. So usually happens in the consolidation. Here's some of the continuation patterns, guys. So let me just tell you which ones they are. So first one is bullish flag. So as you can see, this is a bullish flag. Bullish, i.e. buying wise, bullish, we're looking to buy. So as you can tell, the market is going up, but then there's a little pause here. And the reason they call it flag is because it's printed like a flag. For example, if you have the UK flag, when you go to London Bridge or somewhere in the UK, when you go to New York, you'll see the American flag. So the flag is usually upwards, and the flag is and then it's waving. So the same way, we've got these bullish bullish flag, and then we've got waves in between, and then once we break this flag upwards, then that means that we're continuing with our pattern, i.e. we're continuing to buy. The next thing is triangles. So there's two types of triangles. The most famous ones that I look at, one's an ascending triangle, which is printed here. As you can tell, the reason we call it triangles because that's the actual triangle part. But again, this is bullish trend, so we're looking for a bullish triangle. So that's why the triangle's a bit like that, and it's an ascending angle. And whereas another type of triangle is the symmetrical triangle, which is here, which is more like a slightly curved or slightly, different compared to the ascending triangle. Again, there's also wedges as well that's similar to a triangle, but it's not really like a triangle. As you can tell, it's like a wedge at the end. A triangle is like an actual triangle, like for instance here and here. And now this is what we need to see in the forex market if we're looking to continue with a certain trend, i.e. buying. For instance, this is a bullish example. Bearish example would be the opposite of that, so you can reverse this around. So for example, that would be a bearish flag, because that there would be the opposite way around. So we're looking for that line to be up here, and then the flag breaks downwards, so that's a bearish flag. So, and similar thing goes with these guys. If you reverse them around, it becomes bearish. This is a bullish example because a lot of guys they understand buying better, especially if you're new. Buying just seems more easier because you can see the information, whereas some guys would find selling a bit harder than buying. Again, some guys would find it easier, so it's entirely up to you how you perceive this information into your brain. But then again, we use this information, guys, once again, continuation patterns, we use this information to continue with the trend after the pause, in order to get the high probability, the best trade possible. And then we're looking to use this information in our favor to increase our probability to continue with the trend. Now, the next patterns are reversal patterns. As you know, guys, we were talking about earlier, reversal means we're going the opposite direction. So we're not looking to continue, but we're looking to reverse. For instance, if we've got a bullish trend on US 30, which is the Wall Street Americans US 30 indice. Now we're in a bullish trend, and then the market goes right to the resistance level, and now we see a double top, and now we see a head and shoulder pattern, or now we see a triple top. Now we can use that information to predict that the market is changing its direction, so the market is going backwards, i.e. the trend is reversing. So again, once the information has been printed, we know what's happening in the market. Now we can use that information, we can predict where the market is probably, not most likely or most definitely, probably heading next by using this information. So it's really important, guys, that we understand this information, we perceive this information correctly, and we find our edge in the market to reverse the market if we're looking to reverse after seeing these reversal patterns. And same thing goes for, for example, if we're on a selling trend in GBP USD. Now we've come across double bottom. So these are the patterns: double top to double bottom. This instance here is a double bottom pattern. It's like a W. So as you can tell, so we've got one bottom here, and then we've got the second one there. So again, this is like a double bottom pattern, and this will usually happen at a support level or somewhere where where the market has decided to pause and reverse. It could be a psychological figure, it could be a psychological number, it could be a point that the market's failed to break so many times and usually reverses from. So this is where we can see the information there. Again, triple bottoms are similar to double bottoms, but as you can tell, there's three bounces. So bounce 1, bounce 2, and bounce 3, and on the third bounce the market has decided to go the opposite direction. So we were coming down, we've had the first bounce, then we've had the second bounce, and then we've had the third bounce. And now after the third bounce, the market has broken that top off that bottom, and then they're going upwards now, so we're going in the opposite direction, as you can tell. So a lot of guys would trade this pattern. It's a very good high probability pattern. Again, it's not most definite or most likely, it's just another reason that we can use, or another confidence that we can use to reverse the market. Again, there's other patterns like the head and shoulders, which is here. This is a very common pattern. The reason they call it head and shoulders, it looks quite similar to the triple tops and bottoms, but one thing that you notice here is they're all equal or pretty much equal, whereas here it's like they're not equal. So you can see the first bounce is low, the second bounce is lower, the third bounce is slightly higher than the middle. So it's like, let's just say, imagine we're standing up. Obviously in this case we're lying down opposite way. So this is our left shoulder, this is our head, and that's our right shoulder. And now the market has broken the top of the head and the shoulder, and now we're looking for the market to go the opposite way. Again guys, with candlestick patterns, this is a line example, but with candlestick patterns you'll have to, you can switch to the line chart as I've shown you in the previous video. Please go back to my previous video if you're confused about what line chart is. It just makes things a bit more easier, whereas candlestick patterns you really have to master them, and it can take quite a bit of time, so we can for you to be 100% perfect with candlesticks. Some people it takes them months, some people it takes them years. So the more you learn, the more you educate yourself, the better you'll get. It's like practice makes perfect. That's a really good phrase that I like to use in this instance, because I'm a firm believer that the more you practice, the more better and the more perfect you get. Again, and then also, knowledge is the key to success. So if you've got the knowledge, you've got the right knowledge of the Forex market, now your probability of succeeding in the Forex market is much higher compared to, for example, Joe or someone else who's not really bothered and who's not really putting the effort in. Because without effort you can't really expect results, without knowledge you can't really expect success, and without practice you can't really expect perfection. So that's an example for this video guys. Again, there's also descending channels like these. It's like similar to a bearish flag, but it's like a channel. So flag is usually that way, whereas this is quite different to a flag. But you get the hint. We've going down, then we've had a pause, and now we've broken that level there for the market to say, right guys, we're going the opposite direction, and now you can look to buy. Some people will buy on the break of that. Some people would probably just wait for a little retest or a little retracement so they can get better probability, so they don't just buy there and then market reverses and hits their stop losses. Again, I'll be making a really detailed entry video on entries in future, so please subscribe, please like this video, leave a comment below if there's any questions that you have, and I'll be more than happy to answer. There's also wedges as well. Again, it's quite similar to triangles like I've explained earlier, but it's not a triangle because a triangle on the edge would connect, whereas a wedge at the end won't connect. And then this is where we can see the information why triangles are different to wedges. Now, next thing, and the most important thing after patterns, is candlesticks. I can't stress how important candlesticks are. Candlestick tells you a story, what's been printed. For example, there's different types of candlesticks, and usually they tell you specific information, and they tell you what the candlestick has done, how it's open, how it's closed, and what that probably means for you, for the Forex market, for your trade, and for what the market, how the market is reacting to certain price levels, how the market is basically reacting. If the market is strong, the candlesticks will be big, like really big like this. If the market is weak, the candlesticks would be like this. But see, as you can tell, one candlestick sometimes is enough, because we've got two strong candlesticks here which are closed really well. Then we've had a bearish candlestick, so some traders would think, yeah, we've had a bearish candlestick, sell here, stop loss above there. But then the market makers know this information, and then they will probably, as soon as you put a sell on this candle here, the next candle will take your stop loss. And if you don't have a stop loss, then you will most likely end up losing a lot more than you were going to lose. Again, on entries, I'll be making a really detailed videos that'll contain more information about entries, the risk and rewards, and so on and so forth. So please stay tuned. Now let's get into candlesticks. So there's two types of candlesticks. Like I said to you, there's single candlesticks. For example, like this one here, we can class that as a single candlestick, or this one here, or this one here. So again, we're looking at single candlestick, whereas double candlesticks are, for example, a pattern here. So let's just take these two candlesticks for example. So we've had a bearish candle, and then we've had a bullish engulfing candle. That candle has engulfed, i.e. is greater and bigger, and broke the high of that candle, and now it's going upwards. Now you can use that information to say, look, the market is going the opposite direction, or the market or the buyers are stronger than the sellers because they have engulfed not only 1, 2 but 3 candles, and also broke above the high, the most recent high. Again, there's highs and lows, which I've got to explain in my previous videos, guys, so you can go back to that video. So this candlestick here has broken 3 candlesticks as well as the high, the most recent high, for you to say, look, we're going up, and guess what the market does? It actually goes up. So this is a good buying sign. Whereas a multiple candlestick, you can use this information. For single candlesticks, you can use just one single candlestick like the one here. So I'll more into that onto the next slide. So the next slide is about the type of candlesticks. This particular slide would be on single candlesticks. So I've picked, the 4 famous or the 4 most used single candlesticks that I use, and a lot of the traders out there use. So this is for example purposes only, whilst there's loads of them, but these 4 would probably, or these 3 in this instance would probably be the most that you'll see in the Forex market. So there's 3 types of these. The first one is called the doji candle. As you can see, I've set an example here. Doji candle is a candle that's really weak. As you know, it's showing that the market is indecisive. The market is basically it's failed to close strong, and it's the opening and the closing is almost equal. As you can tell here, it's almost equal. So the market is basically saying that the buyers have got getting weak, and we can possibly look for a reversal. And in this instance here, as you can tell, we've had 3 bullish soldiers, whereas then after that we've had a doji, and then following the doji, the market has in fact reversed. Another candle that we've got is a hammer candle. Again, this is a single candlestick pattern. A hammer is basically, as you can tell, is shaped like a hammer. So this is the nickname for this candle. A lot of traders like to call it the hammer because it's got a long wick and a small body. And these patterns are usually, they're usually identified at the end again. So for example, this would usually occur at the end of the downtrend, for instance here, and the market has headed up. And if it's the opposite way, which is, let's just say if you're going up and this hammer, if you reverse this hammer, then this will become a hanging man. So as you can imagine, like for example, if you go to the gym, guys, and you're hanging up to the pull-up bar, so you'll look like a hanging man, so which is going to be the reverse of this candle. Again, this is mainly at the end of the trend, or to show weakness, or to show that the sellers have failed to push the market down, and the buyers have pushed them back, and they closed. So this candle, when it opened here, it went down. It was a bearish candle, and then the buyers were like, no, we've got to push this back up, and then they pushed it back up and closed it bullish. So it shows that the buyers are now in fact stronger, and the sellers are losing the strength in the market. So we can use this information to buy. For in this instance here, we'd put a buy position here and put stop losses before that. We can ride the trend for until as long as it goes. And if your stop loss is down there, then you still wouldn't get stopped out, because the market would most likely probably would go up in this instance, so you can get yourself a nice little decent trade. Now another example that we've got is the spinning top. So I've done a bearish spinning top here. And these candles, again, guys, they're really short. They have a really short body, so they're not like this with a big body. So they have a short body to show weakness, with a long upper or low shallow. So for example, the wick here, and it represents the indecision in the market. So with this candle, we don't really know if the buyers are strong or the sellers are strong, because it's not really giving us that information. All it's saying is that it's indecisive. Now another candle, what we can do is, once this candle is printed, we can wait for another candle to print, and if that candle prints like this, Now we know that we've got two candlestick pattern. That's a single candlestick, whereas that is a two multiple candlestick pattern that we can use to say, right, we can take a sell position. So we would, in this instance, for example's sake, we would sell here with a stop loss above that structure and ride that trend downwards. Now, I hope that you got the information for single candlesticks. It's really important that you see this in real life charts. When you're back testing or forward testing, when you're sat on your phone or you're sat on your laptop and you go and you look at the market and you'll see this information, and then you can say, right, that's a hammer, that's a bullish engulfing, that's a bearish engulfing, and so on and so forth. And the more you see it, the more you know what that is, the more you practice it, the better you'll get. So I can't stress that enough. Now in this video, in this slide, we are going to be going over what multiple candlesticks are and how we use this information to predict the price where they set next. So again, as you know, multiple is more than one, i.e. plural, where single is single. For example, when you're single in a relationship, you're single. When you're multiple, you're with your partner. So that's a good example of you for single and the multiple, to differentiate between both of them. So now again, multiple candlesticks, guys, they involve more than one candlestick, and there's various patterns in them. So we can use this, if there's multiple candlesticks, for example, in bearish version, they would look like this, whereas a bullish version would look like this. Again, a bullish version would again look like this. So you can use this information to predict where the market is heading next. Bullish engulfing candle is one of the famous ones that a lot of people like to trade. So as you can tell here, if you've printed a candle, the next candle engulf, i.e. is greater than the previous candle, meaning that we can possibly look to buy. Again, the opposite of this would be bearish engulfing, because we're looking to sell, and we've had a sell candle that broke the low of the previous candle, meaning that the sellers are greater than the previous candlestick's buyers. So we can look to sell the market, and in this case scenario, as you can see, it worked really well. Now guys, we use this information to find the best trade, to increase our probability, in order to come out in profits, or in order to make a good prediction, in order to come back in a positive outcome. For instance, here we've got another instance that we've got here is the morning star. As you can see, morning star is basically so when you get up in the morning, the sun's down there, but if it's an evening star, the sun would be up there, or the moon would be up there. So for instance, morning we start from here, evenings we're the opposite. So again, a lot of traders would like to use this information to say, look, we've had a morning star. It looks quite similar to a hammer, but it's not really a hammer, so I don't really want you to get confused, guys. The morning star would usually be this is a bullish reversal pattern. It'll usually just be like a little small bodied candle, either color depending on which direction we're going. So for instance, here morning would be for buying and evening would be for sellers, and then this candlestick basically, it just opens up and the body is halfway up, and it's indicating a possible reversal bullish scenario. In this case, as you can tell, it did give us indication that the market is reversing, and the market went up. So for this instance, you would enter here with your stop loss above here, and you can ride the market upwards. Again, evening star would be the opposite, guys. So you take the same information but reverse it, because we're looking to sell. And three white soldiers are basically like, as you can tell, with bullish we've got three black crows. For instance, they call them black crows because obviously we're selling them, which is this pattern is usually like it contains three candlesticks, so not two but three candlesticks, and then they're basically like the indicator vessel, because you've got three candlesticks showing that the market's going down. For buying, we would call these three white soldiers. So if you reverse these candlesticks, not similar to this, but if they look similar to this but in the other color, then we'd call them three white soldiers, because we're looking to buy. Black crows are here, like I said to you. So you can screenshot these patterns as well, guys, if you wanna keep these saved on your phone, if you need to pull them up, or you can come back to this video anytime and then you can just, I would recommend you to at least watch these videos twice minimum. And then whether you want to refresh your memory after a bit, for example, like after a week, or whenever you think that you're forgetting something, refer back to these videos, guys. It's all there recorded for you on the YouTube channel for free, and you can refer back to any time, and then you can basically pretty much refresh your memory. Another candlestick, they call it the harami, and this candlestick is like a large, it's basically, it's quite similar to, how to explain this now, it's quite similar to a, it's not like doji and a hammer, similar to them basically. And again, you'll find this at the end of the thing. I'll probably just add another example for you guys for the harami in future, but these are the most important ones, and then you can use this information to increase your probability in trading. So conclusion, guys, we've come to the conclusion that chart patterns are candlestick patterns are really important. We need to understand what's going on in the forex market, because without understanding this information, we won't be able to predict where the market's going. We wouldn't be able to increase our probability. We won't be able to add one with one to make it two, so we've got higher confluence to be profitable. But then again, guys, there's no 100% success with these patterns. Sometimes they'll work, sometimes they won't work. You might end up in a loss. There's nothing's guaranteed in the forex market, unfortunately. If it was guaranteed, then everyone would be doing it. It's the more you learn, the more you increase your probability, the more knowledgeable you are, the more you practice, the more you put into it, the more you get out, and that's the way I look at it as well, guys. So again, we need to understand these patterns. We need to understand the way candlesticks are printed. We need to understand the way the charts are printed to perceive that information, to help us pick the right direction and increase our probability in trading. Once again, guys, thank you for watching my video. Please subscribe to my channel. Please like and comment below. We're also on social media as well for you guys to follow. Please follow on them as well. So we're always posting, different things. So that might be helpful for you trading, and hopefully help you become profitable, or become a better trader if you're already profitable. So thanks again, guys, and I hope to see you in the next video. Thank you.